Ladies and gentlemen, good day and welcome to the Symphony Limited Q3 FY23 earnings conference call hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akash Faria from Yes Securities. Thank you and over to you, sir.
Yeah, thank you, Inba. So on behalf of Yes Securities, we welcome you to Q3 and 9-month FY23 results conference call of Symphony Limited. We have with us senior management represented by Mr. Achal Bakeri, Chairman and Managing Director, Mr. Rupesh Shah, Executive Director, Corporate Affairs, and Mr. Amit Kumar, Executive Director and Group CEO. Now I hand over the call to the management for their initial comments, post which we will open the floor for question and answer session. Thank you and over to you, sir.
Okay, thank you, Akash. Good afternoon, everyone, and welcome to this conference call. Thank you very much for being here this afternoon. The customary safe harbor rules apply. This is Achal Bakeri, by the way, and my colleague Rupesh Shah will be making the presentation, after which we will be taking questions. Thank you very much. Rupesh bhai, over to you.
Hello, good evening and welcome to Q3 9 months Symphony call presentation. So customary safe harbor statement is applicable. So as you know, we are in the place of 27-degree world, and so far cumulatively Symphony has sold 25 million air coolers worldwide, at least 4 times higher than the closest competitor. So happy to announce launching of high-tech BLDC air cooler. BLDC fans are available, but in the air cooler, Symphony has achieved the breakthrough in terms of the technology, leading to power saving up to 50%, whereby on an average power saving amounting about 2,000 rupees per annum. This has a feature of up to 8 hours night sleep mode, and there are 7 speed options. As such, because of BLDC technology, one can set the speed at any level, but as of now it is 7 level speed option, and we have fully functional remote control. To start with, we have 3 models, Diet 3D, 2 models, and Winter. And obviously, in line with the technology, this will be premiumly priced with a decent profitability. So coming to performance highlights, during first 9 months, that is April to December, it has been the highest ever standalone as well as consolidated sales vis-a-vis historical high. Gross profit margin percentage as well as EBITDA margin percentage have improved on YOY basis. Now standalone EBITDA margin percentage excluding other income stands at 19.9%, up by 270 BPS YOY, while consolidated it is 13.1%, up by 110 BPS. This has been achieved on account of better model mix, decent price increase, and softness of input costs. However, in many models, we have substantially upgraded in order to have competitive edge and better sellability. And as far as our overseas subsidiaries are concerned, particularly climate technology, the performance has been subdued on account of demand headwinds in US and Australia, and in a short time is likely to continue that way. As far as Q3 December 23 quarter performance is concerned, on a standalone basis, it has been the highest ever sales vis-a-vis the historical high. There has been robust off-season sales and trade sentiments across the channels, across the geography, across the models and range, quite positive and buoyant. Again, gross margin as well as consolidated gross margin percentage coupled with standalone EBITDA margin and consolidated EBITDA margin percentage are higher. Now standalone EBITDA margin excluding other income stands at 25%, jump of 300 bps YOY for the quarter, while console is 15.8% on account of the reasons I explained earlier. Coming to reward to the shareholders, Symphony does follow consistent reward policy and we have a stated payout. So just to summarize, in last 10 years until 31st March 22, 51% of the PAT has been paid out. In last 5 years, it amounts to 53%, and in last 3 years, that is until March 22, it amounts to 71%, inclusive of special one-time dividend of rupees 90 in February 20. And now in today's board meeting, the board has approved and announced share buyback up to rupees 200 crore at a share price of rupees 2000 per share. If it is fully bought back, it will amount to reduction in paid up share capital of 1.43%. So this will lead to total payout of 250 crore, including about 50 crore buyback tax and incidental expenses. Currently, our net worth stands at about 800 crore, and this buyback and payout will reduce the net worth in excess of 30%, which will lead to approx return on net worth and return on capital employed percentage in the first year by around 4%. And obviously, just like any buyback, this is EPS accretive. Further, we have changed the shareholder reward policy. As many of you may be aware, until now, it was payout up to 50% of the PAT. Now, board has decided in today's board meeting, it stands increased to payout ratio of 60%. This has been decided considering our asset-light, capital-light business model, and we believe that we may not require any major treasury on hand. And of course, this includes dividend, special dividend, and buyback. So coming to 9 months standalone financials represented by Sankey chart. So revenue from operations on standalone is up by 65% in 9 months. EBITDA stands at 129 crore, up by 92% versus top line increase of 65%, and profit after tax stands at 122 crore, that is 19% PAT margin, up by 79%. So these are some of the detailed charts. So on 9-month basis, standalone turnover up from 390 to 646 crore, and profit after tax up from 68 crore to 122 crore, about 19% of the revenue from operations. Coming to December quarter, Q3 financials, top line is up by 52%, up from 146 to 223 crore. EBITDA is up by 73%, and now EBITDA, excluding other income, stands at 25% versus 22% last year, while including treasury income, EBITDA margin percentage on standalone stands at about 29% and profit after tax up from 29 CR to 52 CR. And this is the waterfall chart of movement of EBITDA for December quarter. So as it can be seen, gross margin has improved by 1.4% on account of higher sales. Percentage of employee cost has come down by 2.6%. However, in advertisement, freight and other expenses, there is a marginal increase ranging from 0.2% to 0.50%. Coming to capital efficacy items, capital employed during December quarter back to pre-COVID highly efficient. So in a core business, it is negative 31 crore on account of robust off-season collection, and hence PBIT percentage on capital employed theoretically translates to infinite, having total treasury of 637 crore as on 31st March 22, and on trailing 12 months, the return on net worth stands at 20%. Coming to consolidated financials, about Sankey chart, YOY, the top line stands at 880 crore, up by 34%, lower than standalone due to headwinds in US and Australia as explained earlier. EBITDA is up by 46%, that is 115 crore, while PAT is up by 76%, stands at 100 crore on a consolidated basis. And some of the key profitability and revenue charts. So top line on a consolidated basis for 9 months up from 655 to 880 crore, while profit after tax up from 57 crore to 100 crore, up by 76%. And gross margin has increased on a consolidated basis despite headwinds in subsidiaries from 44.4 to 44.7%. So about quarterly financials. For December quarter, consolidated top line is up from 205 to 277 crore, that is 35% up, while profit after tax is up from 21 crore to 39 crore, about 14% of the top line, and growth percentage is about 84%. And this is the waterfall chart of movement of consolidated EBITDA margin percentage in Q3. So on a consolidated basis, gross margin percentage has reduced by 0.6%. However, on account of economy of scale, employee cost has come down percentage-wise 3.4, while there is marginal increase in 3 other expenses, and it stands at about 15.8%. And coming to consolidated capital efficacy, the average capital employed based on the monthly opening and closing for 9 months, consolidated capital employed stands at 235 crore, which translates into PBIT percentage for 9 months, not annualized, 17%, while return on net worth on trailing 12 months is 20%. Coming to the outlook, as far as domestic market is concerned, there is a decent visibility of consumer sales, again across the products, across the channel, across the geography. We see overall buoyancy. Symphony will keep on launching, as just shared with you, BLDC and many other value-added products. Still there will be graded price increase, and there may be further advantage on account of softening of input costs, with an objective of reaching to EBITDA margin percentage of historical high. The current global economic situation has already led to demand headwinds, especially in United States and Australia, and we are likely to see the impact of that in the short term. But we believe that some of our large customers who have curtailed the order, maybe during the season, they may run out of stock. And on account of our globalized operations, mainly because of multiple R&D and D&D facilities, outsourced manufacturing facilities, supply chain, and very agile logistic arrangement, we are optimizing in various respects. Thank you. So with this, open the floor for question answer.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and one. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Manoj Gori from Equirus. Please go ahead.
Yeah, many thanks for the opportunity. So just for understanding, would like to understand, like you highlighted various initiatives to improve the gross margins. But when I look at sequentially, gross margins have been impacted, especially on consolidated base numbers as well. So is it largely because of extra discounts or schemes that we have rolled out for US or Australia markets?
Yeah. So as far as Q3 standalone EBITDA margin is concerned, it has improved from about 22% to 25% as far as Q3 is concerned.
So I'm referring to gross margins over here.
And coming to gross margin percentage, even on standalone basis for 9 months, it is up from 46.4 to 47.5%. This is about the standalone. Now coming to consolidated, the gross margin is up from 44.4 to 44.7%. So only nominally higher. While EBITDA margin is also up from 12% to 13.1%. On console basis, the impact is not as high as standalone basis on account of headwinds in global demand due to economic situation.
Right.
But also we have also been witnessing increase in costs, especially in Australia, and which we have not been able to pass on to our customers. So I think the bigger problem in Australia has been that, but that is the situation which is being in the process of being corrected.
So can you highlight like what are those cost items? Because if you look at RM pressures are definitely behind us, plus logistic cost, if you look at, that is definitely has come down at global level. So can you highlight like what are the costs that are actually impacting the margins over here for this Australia business?
So it's a variety of components, whether it is metal or plastics or even freight, domestically within Australia. So I think those are the ones which we have not been able to pass on. And on top of that, the market over there, we have also not been able to sort of, in some cases, been able to sort of match our competitors who have been giving extra discounts. So it's a combination of factors within Australia.
Right. And sir, if you look at, so probably when we are seeing some demand headwinds, as Rupesh ji already highlighted, like some of the larger clients might see shortage of stock and there might be some buying again. But when do we expect normalization in the overall operations, at least from a US or from Australia point of view? Because if you look at your Q4 was extremely heavy last year for your exposed business, even in your standalone entity.
So even this year, there will be significant sales in Q4 in the US. However, the overall business in the US is going to be much lower than last year because our major customers over there, and primarily the largest of them all is the Home Depot, has cut down their orders in anticipation of a recession in the US. Now, I think from what we have gathered, this is something which they have done across the board for all products that they sell. They are trying to sort of destock and reduce their inventories in anticipation of a recession. But our sense is that come summer they will run out of inventory, and very honestly, there will be no way of filling up of fulfilling that excess demand, which they won't be able to fulfill because the entire cycle time is in excess of 3 months for us to produce here and ship coolers to the US. So that demand would be lost. So we don't expect us to be able to recoup that demand even if the summer is great and the recession is not so severe. So that is a certainty as far as this year is concerned.
Right, understood. And sir, lastly, if I may squeeze in one more question on domestic business. So obviously, when we look at the Q2 and Q3 performance, domestic business has been back on track, and obviously margins have also improved over here. So with Q4, obviously, when we look at the base is favorable, and in Q1 also, though 1Q FY23 growth number seems very high, but channel was still carrying some older inventories. So should we expect like there is a strong visibility and channel sentiments, as Rupesh ji highlighted, is very positive. Should we expect strong performance during Q4 and Q4 and Q1 of next year?
That is something that we certainly expect. We certainly expect that internally. A much better performance in the current quarter and in the next quarter. We certainly internally do expect that.
Right, sir. So that's all from my end. Thanks and wish you all the best, sir.
Thank you very much, Manoj.
Thank you. Our next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah. Hi, good evening, team, and congratulations for the strong performance. I have 3-4 questions. First, coming back to gross margins. Now here I'm comparing the standalone gross margins in 3Q with the standalone gross margins in 2Q. And there has been a sequential drop of 120 basis points despite softness in commodity prices. So we're just trying to understand that typically sequentially we see improvement in the gross margins as we start nearing the season in terms of pricing. So what has led to weakness in this India EBIT margin as well as gross margin at the standalone level?
Okay, Renu, let me answer that. See, you should not read much into sequential because it is a function of the sales mix and product mix. That's number one. Number two, you would have also seen that in December quarter, there is also major export sales, including sales to subsidiaries, where margin is divided. And hence, the real reflection is 9 months as a whole and Q3 versus previous year Q3.
Got it. Also, when I compare the India, as in standalone India revenues, like-to-like comparison, yes, that has improved relatively by 100 to 200 basis points there. So, get your point. Okay. Second question is, last time when we spoke, you had mentioned that there were significant cost out actions undertaken in Australia to reduce, in CTL, to reduce the fixed cost of that subsidiary. So where are we in terms of turning around the performance of this business? And also in the backdrop that it is very certain that US sales, which last year were fairly strong, this season will be declining. So how are we gearing on the cost side for this unfortunate turn in revenues?
So, the entire sort of what we call business process transformation that we are on in Australia which we had embarked upon soon after we acquired the company, is actually behind schedule. Basically, essentially because of COVID. During COVID, nothing could happen, and that is something which we will only probably witness, in the next 2 years. So that is a process. It's a process which is on, but what should have been done by now is actually a full 2 years behind schedule. So that's all on the cost of doing business front, on the CODB front. On the COGS front, again, there are a lot of measures have been undertaken, but unfortunately those have been negated by the sharp increase in commodity costs. Commodity costs, although are lower now than they were at the peak, but they are still significantly higher than they were pre-COVID levels. For the year as a whole, both Australia and the US together, the entire climate technologies company is not going to be not going to see a very healthy numbers.
Sure. Mukesh, can we also have some updates on the 9-month or 3Q performance of the subsidiaries, INCO, GSK China, and CTN, at least the headline operating numbers?
Okay. Sure, Mukesh will. Yeah, go ahead.
So climate technology top line is 173 crore. I am saying in INR, and at a PAT level it is negative 17 crore. As far as INCO Mexico is concerned, it is 80 crore and PAT is 1 crore. And in case of GSK China, top line is 27 crore and loss of 2 crore. This is what summary of 9 months subsidiary performance.
Got it.
So keep these figures handy for you.
Thank you so much, sir, for sharing them. It helps to understand how the individual businesses have done. Now, coming back to the base India business, as in you have highlighted that the summer advances have been fairly robust, which has helped working capital improve sharply. Can we expect, as in if you go back 2019 or 2019 December 19 quarter pre-pandemic, we had a similar 200 crores kind of standalone sales, and it's almost about 10% growth. So given that if business, everything is back to normal and summers is good, can we expect again a robust growth coming back? And this time around, do you see a bit of focus on the economy segment also, which we had sharpened in the last 2 years with more SKUs should help widen our market share as well as growth in the domestic business?
Yes, Renu, both on the top line and the bottom line in the current quarter and in the next quarter, we expect a significant improvement in performance. And also the model strategy that you spoke about is also something which is very much, very much happening. So yes, all of those sort of levers are being used.
Sure. And last, if I can ask any updates on the industrial air cooling business, how is that progressing? And given that capex activities also is in general improving at the factory level, how has this business performed for the 3Q and YTD?
Certainly, the growth has been very, very high in I would say, very high double-digit growth. However, the base being what it was, a relatively low base, in absolute numbers, it is still not something which may be worth talking about, but it is certainly growing very well and is growing that business is moving in the right direction.
And in terms of the product acceptance, and as you know, the business model-wise, credit terms-wise, it is at par with residential air cooler. While it comes to the profitability, it is even better than residential.
Got it. Thanks much, sir, and all the best. Thank you.
Thank you.
Thank you. Our next question is from the line of Onkar Gugadre from Shrees Investments. Please go ahead. Onkar, your line is unmuted. Please go ahead with your question.
Yeah, my question was regarding actually the subsidiary performance. If you look at the 9 months figure, the revenue is contributing around 35% to the top line, but profit is here for everyone to see. I mean, every quarter there comes some headwind. So what do you think about the performance of the subsidiary and its overall impact on the profitability in the long run?
So since you specifically say the long run, we will say that we are very confident about profitability in the long run. If we were to again break down the subsidiaries into three key components, which is Australia and the US, or actually four: Australia, US, Mexico, and China. So as far as Mexico is concerned, it has remained profitable. We have had to take some haircuts with some sort of write-offs that we had to do with some customers who have gone bankrupt because of COVID, which has affected the profitability. But despite that, it still remains profitable. China is, we've been able to bring down the losses significantly. We have not even been able to go to China since 3.5 years, 3 years and 4 months. So that is something which remains a question mark. As far as the US is concerned, yes, there was this sort of expectation of a recession, which has led to our major customers cutting down on their orders, which we believe is completely unfounded. But nonetheless, that is something which is being witnessed across the board, across all retailers, across all products in the US. So that's something which we expect to correct. The situation that we expect will be corrected by next year. As far as Australia is concerned, I spoke about a little earlier. We are in the process of sort of changing the business model, and that should the entire benefits of that should be visible in about 2 years' time. Along with that, we have added new products and are in the process of adding new products over there, which have much better margins, and are working hard on improving the margins on the existing products. And all of those should surely see effect in 23-24. So while I understand where you are coming from, but believe me, we are equally impatient, if not more, and we are, again, extremely concerned about it and working, our best, trying our best to sort of turn things around.
And just to add to that, in 21-22, mainly on account of US performance and INCO performance, 21-22 year as a whole, rest of the world, that is subsidiaries and exports put together, contributed 50% of the top line, while rest of the world, in terms of the PBIT, contributed 40%. But on account of reasons just mentioned, current year, again, it's not doing well, but otherwise, last year, it was a significant turnaround.
Yeah, but that's been only 1 year, sir, right? If you look at the history, say last 3-4 years, the overall performance has been dragged by the subsidiaries.
That's right. That is true. But we also see the subsidiaries as an opportunity going forward. So which is why we are hanging in there and making sure that the dragging down will be a thing of the past as we move ahead.
Oh, and I specifically asked this question: what would be the impact for the long run? Here you categorize long run as, say, how many years? 2 years, 3 years, 5 years?
2-3 years. 2-3 years. In the long run, as the saying goes, we'll all be dead. So what matters is the next 2-3 years.
Okay, so you expect around like what kind of performance, what percentage do you expect at least to add to the bottom line because of subsidiaries? A ballpark figure I'm asking.
I wouldn't venture into that, because I really don't know myself. I don't know what to expect. We don't know how it is going to be. So I really wouldn't venture into hazarding a guess.
Yeah, but as of now, if it is contributing around 30% to the top line, there has to be a decent contribution to the bottom line as well, right? Otherwise, there is no use of doing those things, right?
We are on the same page. Yes, absolutely. Absolutely. We are very much as an organization philosophically focused on the bottom line. We just don't chase top line for the sake of top line. We chase top line provided it generates the bottom line that we seek. Otherwise, we are not here to cool the world.
Okay, all right. A similar a follow-up to that is you had taken a loan for this climate technology acquisition. Do you think it would have been better not to take the loan and go ahead with you should have gone ahead with the cash you had at that time to acquire the...
We can still do that. See, there is nothing like, we can still do that. We can still pay off the loan. We still have the money on our books. But we had done that for a reason. And we also have to remember, actually, that the part of the dragging down of climate technologies is because of the interest that it pays on the acquisition loan, which in reality shouldn't be considered in its performance. But we have taken it for a reason, and that reason, as of now, still remains valid. If we want, we can pay off that loan. It takes us very little to pay off that loan,
Okay. As of now, how much loan you have to pay to entirely clear of that?
How much? 20 million.
Acquisition loan outstanding is $20 million against original availed $25 million.
20 million Australian dollars, which is about 100 crores.
So that is still to be paid, right?
Yes.
Okay. And what's your plan on that front? Like, when do you plan to?
It's a half-yearly repayment as decided with the bank.
And that is being done.
Okay. But like, in how many years you plan to pay off that entirely?
The balance period is about 4 years.
4 years from?
From now. Balance from now.
Okay. 4 years from now.
But irrespective of that, at any point of time from our treasury, we can always prepay. But there is a lot of sense and logic in having that loan, because otherwise Australian dollar fluctuates. And if we would have granted that loan from India, there would have been huge forex fluctuations. That's number one. Number two, even in today's time, that is as of today, including hedging costs, the interest is just 3.85%, while today's LIBOR is 4.5%. So just consider that the cost is lower than LIBOR. Otherwise, there is a spread of 2 to 3%. That's number two. And number three, the same amount we are deploying in the treasury in India, and today, pre-tax, it is generating 7%. So by the way, end to end, it generates alpha in excess of 3%. And still there is an option, as and when required, we can prepay that. But it doesn't make sense to us. And also partly, in case of acquisition, it also needs some discipline at a level of local organization in terms of the performance and cash flow. So to an extent, it serves that purpose too.
Okay, thanks for the detailed answer. I have a suggestion or just a thinking, like instead of focusing 2-3% alpha over here and there, I guess management focus should be there on to doing a business which is more profitable than generating 2-3% alpha, right? I mean, focus should be there on that. I'm not saying it's not there. I'm just stating my views here.
Thank you very much for your advice.
Yeah, thank you. The next question is on the 60% payout which you mentioned. Earlier it was up to 50%, right?
Yes.
That's right.
And now it is 60%, not up to 60%.
It is up to 60. Everything is up to.
Okay, because in the policy, the dividend policy, you have stated at least 60%.
Yes, it is at least 60%. You are right. Earlier it was up to 50%. Now it is at least 60%. Of course, subject to contingency, etc., etc.
Okay.
Because we believe that in our business model, being asset light, capital light, and as you would have seen that on a standalone basis, there is a negligible capital employed, whether for the quarter or for 9 months, and similarly on a console basis, it's just about 235 crore. So we need not to keep much cash, whereby to track down the ROC or RONW.
Okay, just one question on the buyback front. If you say that management is or the promoters are also participating in the buyback offer, don't you think that would have, if the promoter wouldn't have gone ahead with the buyback, I mean, participating in the buyback, that would have been more beneficial to the retail shareholders?
So that decision you should leave it to the promoter and concerned shareholders.
Yeah, so that's what I'm asking, right?
So here also, by the way, now to answer your question, minority shareholders, as per the definition, shareholding is just 1.86% as of now, while their reservation is 15%. So against 1.86%, they are going to get 15%. And can you please tell me why promoter should be penalized? And despite a minority shareholders getting about 8 times to their share, why they should be rewarded even higher? And that too after offering the buyback price of 2,000 rupees against the current price of 955.
Correct. That is one point. But one thing also is there that for last 6 to 7 years, there has been no return for the shareholders as well, apart from the dividends which you have paid, right?
But if you don't like, you need not to remain invested. There are more than 5,000 companies in the country. We are not asking anybody to marry with the company, isn't it? That is number one. And number two, there are many. See, you should have a patience to listen the answer fully. Please allow me to respond. So what you are comparing is 5 years to 6 years. There are the shareholders for 15 years, 10 years, 8 years, and last 2 years also. So your perception may be this, and there are shareholders who are giving us many complimentary emails. So it depends upon that.
Sir, myself, I have been a shareholder for 15 years. So just to clarify that.
Fine. So
yeah.
still if you are
yes, so you have been handsomely rewarded on your investment.
Yeah.
So you have no reason to complain.
Yeah, I'm just asking for your opinion, sir. There is no complaint and anything I'm talking about. I'm just asking for the promoter's opinion.
If somebody is in a capital market, one should be ready for the up and down. Only on the Excel sheet business just grows up and chart shows up, isn't it? As you yourself being in a capital market for so long.
Yeah, like the way I gave you the advice. Thanks for this advice as well, sir. Thank you.
Thank you. Thanks.
Thank you. We'll take our next question from the line of Nikhil Gara from Abacus Asset Management. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity and congrats on a very strong set of numbers, especially on the standalone business. So my first question is regarding the standalone business itself. And, while our main season will start in the upcoming couple of quarters, we have seen certain amount of slowdown, if I can say so, in the other sort of consumer verticals. So what is your view in terms of, how we can sort of get hit by it, if by any chance, or you do think that this might be one of the best summers we have?
Our category, fortunately or unfortunately, is decoupled from the economy. What really matters is, the only thing that really matters is the temperature in the summer. If the temperatures are high enough and consistently high enough, then regardless of how badly the economy is doing, we will sell. And the converse is also true. So far, and again, last year was a very good summer. So the channel has completely exhausted its inventory. So which is why the channel has been restocking since the end of the summer. And the channel is fairly upbeat about the prospects of the summer to come. And I don't want to get ahead of myself, but we are already witnessing high temperatures across the country. Although it's just the first week of February, you're seeing 35 degrees in Bangalore and 34 in Pune, and right here in Ahmedabad is 33 degrees. So we are seeing, and there in fact even has begun some tertiary movement in coolers, in the market. So if all goes well, if this continues, if there are no surprises, then we should see a very good summer.
Got it, sir. So you mentioned.
Please remember, I said if.
Yes.
There is a capital if.
Yeah, we understand that. So, just on the price hike that you mentioned, can you quantify what kind of price hike we had taken in the quarter, and are there any further price hike that you need to take, or because since the commodity prices are now correcting, you are more or less okay with the current pricing that we have?
No, we have been, increasing the prices every month in small measures from last year, from about 7, 8 months ago, and that is continuing even as we speak. So regardless of the commodity prices, or because please remember that the commodity prices are still higher than what they were pre-COVID. They may have come down from the peak, but they are still bill of materials costs are still higher than what they were pre-COVID. So this is something which is going to go on. Our EBITDA margins, which are at 19.9%, were much higher, a few years ago. So our eventual goal is to be at those historical sort of EBITDA, gross and EBITDA margins. So we are working towards that. So our price rise is something which is going to go on.
Got it, sir. And just two more questions. So just one on the margin front, specifically once again to the standalone domestic business, if I can say so. We have done, in the past, we have done margins upwards of, 28, 29% on EBITDA level. And now that a lot of business in the domestic also happens because we supply through exports. What kind of a realistic EBITDA margin would you internally target from that perspective? Is it 25% that we are already hitting the best margins we can do, or you feel?
No way. We are looking at our historical high of 32.
Including the exports that we do to.
No. I'm saying as a standalone, on a standalone basis. Now, with exports or without exports is a matter of detail, but comparatively, it can be on a standalone India business. Let's say we're looking at 32.
Yeah. So on domestic sales, it will be 32%.
Domestic sales, yes.
Understood. Got it. And that as of now would be 80% of the overall standalone numbers, right?
About that.
Yeah. Okay. Yes.
Understood, sir. And lastly, sir, regarding the Australia business that you mentioned that we had planned to turn it around and create a sort of a more enhanced sort of a business model or differentiated business model. Sir, can you, for just a benefit, sort of highlight what you are trying to do over there, because I might have missed that in the past.
No, we haven't even elaborated on that in this call today. But what we are trying to do is, there too we have a vertically integrated manufacturing facility, which we are converting into an asset-light third-party manufacturing kind of a facility. We are locked into a lease which goes on until June 25. So that is one other major cost which we are trying to exit from, and changing the business model from in-house captive manufacturing to a third-party manufacturing. So all of those are works in progress. It isn't as if nothing has happened. We are sort of halfway there, but there's still some work that remains to be done, which as per our original plan would have been sort of behind us by now. But in those 2 years of COVID, really nothing happened, but so that's one thing on the CODB front, and on the COGS front, already we had, like I said a little while before, we had done a lot, but that has also all been sort of washed out by the increase in costs. So that is broadly what we are attempting to do with the company in Australia. And on top of that, we are also adding products which have much higher gross margins than the current products that are being sold.
Got it, sir. So Australia is how much of the total CT business, Australia region?
So Australia till we had the company, almost everything came from Australia. They had barely maybe about $5-6 million worth of business in the US. How much was it? about 20 crores of business in the US till we acquired it in rupee terms. And last year was 140 crores. So, from 20 crores to 140 crores, that is what the sort of swing that happened primarily because we acquired the company, we added products, and all of that. So till that happened, it was 20 was US and Australia domestic was maybe about 250 or so. Now, last year, what was the total?
About 370 crores, out of which
140
was
US and 230 was Australia. So you can see what now again this year there is going to be a decline in both the US and in Australia, but at least that is what we were able to do last year.
And importantly, US business at EBITDA percentage and PAT percentage is even more profitable than domestic business in India. Considering everything, that includes margin which is retained in Symphony India and margin which is retained by Climate Technology. But the point is US business is generating that kind of profitability. And number two, apart from one large customer, we have also forayed into D2C as well as e-commerce on Amazon. Of course, it's a beginning. So initially there will be a small sale and there is a good potential.
Got it, sir. Thank you so much for answering my questions and all the best for the future. Thank you.
Thank you very much. Thank you.
Thank you. Our next question is from the line of Rahul Gajre from Haitong Securities. Please go ahead. Looks like Rahul's line is just dropped from the queue. In the meanwhile, we'll take our next question. That's from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hi, sir. Hi, thank you for the opportunity. Sir, I had one question. So when we, in the result section, the company has provided the revenue bifurcation based on the geography, India and rest of the world. So in the rest of the world, the revenue for Q3 is 79 crore versus 84 crore. So is it because the decline is because we have shipped some products from the India, that's why the India revenue is higher? Is my understanding correct?
Yes, part of the production for Inco Mexico, which earlier used to take place in India, that has shifted to Mexico.
So because of the high shipping costs, we sort of relocated some manufacturing from India to Mexico. So instead of shipping from India, it is being now produced within Mexico, both for the Mexican market and as well as we are using that to supply to the US market.
Okay. So because the sales have come down, so I thought maybe the exports would have been done from the domestic market, Indian markets, is my understanding. So just wanted to clarify further. So in so 3 crore India market sales versus 121 crore, and for the rest of the world, 79 versus 84. So is my understanding correct? Because we have shipped more product from India for these markets, that's why the revenue from rest of the world has come down?
We have not fully understood your question. Can you repeat your question?
So, sir, in the financial numbers, in the consolidated numbers, you have given, a company has given the revenue bifurcation based on the geography. So, India revenue 198 crores. So that is it? Okay. Just a second, I'll tell you the page number also for your.
Yeah. It is there 198.
Okay. So this is because the higher revenue is because we have shipped the products to the export market from India.
No, so India 190 is comprises only domestic sales from India, right? And whatever 79 rest of the world is comprising of the subsidiary sales and India's exports also.
But I believe your question is last year it was 84, current year it is 79, and even in September it was 84. So why there is a decline?
So decline is subsidiary sales.
Correct. So decline is, as earlier explained, some of the export from India to Inco Mexico. Now that happens domestically in Inco Mexico on account of logistic cost, mainly on account of that. Otherwise, 9 months as a whole, rest of the world is 304 versus last year of 313.
And there is some decline in climate technologies quarterly revenue, so that's why the rest of the world is lower if you see the consolidated quarterly results. So 84 versus 79 is due to the subsidiaries decline in the revenue in the quarter, mainly climate technologies.
Okay, sir. Thank you for clarifying. And sir, one more point regarding the advertising expenses. They have gone to increase to 6% of the total revenue for the 9 months. And in the past, they have remained in the range of 4% for the console and for the 5% for the standalone. So any guidance on that part in the coming quarters or years?
So Rakesh, as we have explained earlier also, this summer season that passed, and in the 9-month data you would see it includes the summer season for last year, calendar year 22. There was substantial starting inventory in the channel, which had to be pushed, and we needed to create enough pull for that. So increase in A&P was to support the channel inventory liquidation in the market last year, and we intend to get back to our traditional 4.5 to 5% A&P expenses as we move forward.
And secondly, there is also good amount of cost incurred on D2C as it normally happens. So it is inclusive of that. And secondly, in current year, especially in September and partly in December quarter, there has been one-time sales promotion and marketing on account of some of the market research also, market research expenses. But we have fully treated them as revenue expenses.
Okay, sir. So that is from my side. Thank you.
Thank you. Our next question is from the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good evening, sir. So just wanted to understand on the Australia business. After the acquisition, we also had plans that we'll start shipping some products from India and Chinese facilities. So I understand that those plans had gotten disrupted during COVID. But as of now, we want to have completely local sourcing mechanism, or are we still open to the idea of exporting a fair bit from India and China?
No, Aditya, we had in fact, last year supplied everything from India. But then the freight rates went up so high that the cost of freight was much higher than the saving in the manufacturing cost. So we in fact relocated the manufacturing to Australia this year. And as I said, to reply to an earlier question, in the case of Mexico also, we sort of began manufacturing some products in Mexico only to save on the freight cost. But now, going forward, if the freight rate come down to pre-COVID levels, it will still make sense to produce in India and ship directly from India. And our business model and our manufacturing process is fairly agile and fairly flexible. So for us to locate or relocate, it requires effort, but it is not something which requires tremendous cost, because it's all third party. So whether we find an OEM in India or a third party manufacturer in India, or we find a third party manufacturer in Australia, is all that it takes, and then relocating the tooling. But to answer your question, we had already begun to manufacture from India, and then we had to relocate to Australia.
Understood. And at the current freight rates, it makes sense to be procuring from Australia only. Freight rates would need to come down meaningfully even from current levels for sourcing to happen.
Absolutely. Yes. So that is also one of the things which I was referring to a little while ago in response to another question, that many of the sort of measures that we had put in place, were washed out by the increase in freight rates and increase in costs. So that was another thing that I was referring to.
Sure. That explains, sir. And so regarding our D2C business foray, if you could just kind of spare 2 minutes and explain to us how exactly is that progressing, how large that business could be today, what are the costs that we incur in respect of that, and what are the plans that we are having?
D2C?
Yeah.
Okay, I'll maybe request Amit Kumar to respond to that. Amit?
So, Aditya, D2C business is still a nascent business. We are building the channel both in India and in other territories, including Australia and US. As of now, it accounts for a very small percentage of the business. But what we are focused on is building it profitably and working it in a way that the cost for us, the average cost of sale on the channel remains in the acceptable territory. So this is work in progress, and between this year and next year, we will definitely take it to the next levels where this is integrated into the overall approach that we are building on the omni-channel front, where D2C also feeds into our sales through the traditional channel. So that's the larger approach, and as the volumes become more material, maybe we'll be able to share the numbers also.
Probably, as things stand, I believe in current year or at least in current season from D2C, we expect at least positive EBITDA despite this cost.
Absolutely.
Yeah. So there is going to be positive EBITDA in D2C despite it is at nascent state. That's how it has been strategized.
Understood, sir.
Wasn't the case.
And just one last bit, if I may add, in semi-urban areas and rural areas and versus unorganized players, there are some initiatives that you have taken. How exactly are those shaping up? And are you seeing an expedited shift happening from unorganized players?
So, Aditya, unorganized continues to be a large sub-segment within the coolers market. And as we work into the market, we are working on two streams. One is increasing the dealer penetration. So there is a focused Bharat range of products which is aimed at taking us deeper into the hinterland and deeper into the unorganized market network. So that's one approach we are taking through a focused product and range going into the smaller retail and hinterland kind of market. The second approach we are taking is also leveraging a couple of again specific products aimed at the rural market, which are designed bottom up for that segment, and a few of those we will launch within the current.
Understood, sir. That's helpful. Thank you so much.
Thank you. Our next question is from the line of Rahul Gazre from Haitong. Please go ahead.
Thanks for the opportunity. Sir, most of the questions I've got some clarity, but I just need some more details on some of the areas. Now, you talked about price hike that the company has taken over the last several months. Two aspects I want to understand. How much is the total price hike that you have taken in the first 9 months? And what is the gap or the price that you still need to take in order to be neutral on the increased input cost?
So Rahul, first of all, these have been, I would say, very moderated price increases.
Right.
So we have not attempted to take a big bite in any one go. So these are all small increases that we effect every month, and these will go on regardless of where the prices are. It is the price hike is actually not a function of the cost, but is more a function of what we believe we can extract from the market.
Okay, right.
So whether the costs go up or down, cost may go up and price may have to go down in certain situations. You know what I'm saying? So the price and cost actually have no correlation with each other.
Okay. So the second question I had was, on the subsidiary sales. Now, in the second quarter, I recollect, there was some sales deferral in climate technologies. What you've talked about with Home Depot deferring inventory stocking up. Now, that deferral of sales in climate technologies in the second quarter, was it more US centric or was it US and Australia?
So that Home Depot thing was all US. So that has been deferred, but that has also been significantly reduced. So what we had sold last year in December is to a great extent going this time, in the new year, post-January, but is also significantly reduced from last year. Overall orders are significantly lower than last year.
Right. Okay. Fair enough. Because, that deferral was expected to come in the Q3 sales. So obviously
Correct.
that has not happened, right? Okay. So my last question is on, on the other expenses. In the second quarter, we've had several...
Rahul, wait. It was supposed to come in Q3, is happening in Q4. Our point was that.
Okay. So either Q3 or Q4, that deferral sales would have come through.
Yeah, sorry?
So I'm saying that sales would have either come in third quarter or the fourth quarter. That's what you're basically saying.
Correct.
Right. Which is not happening this time around.
It is happening, but the overall sales is going to be much lower than last year.
Okay. So my last question is on the cost. Apparently, there were several one-time costs, certain expenses in the second quarter. Now, in the third quarter also, I see, the other expenses is elevated, both at standalone level and Concall level. So are there any such one-time costs which are sitting in the third 3Q numbers?
What are you referring to, Rahul?
Sir, last time there were, off-season sales promotion. There were
in this quarter, there is no one-time type of expenses, only the very few advertisement costs actually.
So these are all routine business expenses.
Correct.
Right. Okay, sir. That's all I had. Thank you very much and all the very best.
Thank you.
Thank you. Our next question is from the line of Manoj Gori from Equirus. Please go ahead.
Thanks, sir. So a couple of questions. One, obviously, Amitji have highlighted many things for the domestic market. So product innovation has been one of our many strengths over the years. So apart from this, in the long run, probably can you highlight what would be the key focus areas which would help us grow faster than the industry, whether it's unorganized or the total air cooler industry? Can you throw some light over there?
Manoj, so it's going to be more of the same, Manoj,
Yeah.
Yeah, so it's not that we have any sort of magic wand or a magic bullet. It's going to be just more of the same, Manoj,
Right.
Constant innovation, constantly kaam karo, and, this new markets or existing markets, whether it's India, Australia, US, Brazil, Mexico, China. So the same markets, maybe new customers in the case of US and Australia, even adding new products. Even in Mexico, we are adding new products, looking at adding new customers. In India, it will be, again, continuous innovation as far as products are concerned, and grow the industrial cooler business, grow exports from India. So it is just it's more of the same.
And keep up rapid increasing the marketing network continuously across the channel.
Correct. So all of those things which we have been historically doing, whatever had to be done or whatever could be done, we have already done. We just have to keep on doing that and keep on doing that, more of that and do it better.
Understood.
Continuously.
Understood. So last question. So if you look at, we recently or probably some time back, we came out with this bladeless fan also. Are we seriously considering to get into any other categories, or probably this was just a similar category, or probably to air coolers, and accordingly we launched it?
Correct. So this was a very good adjacency to coolers, and which is why we sort of got into it. From our point of view, it is basically a cooler without water and a tank.
Yeah.
Otherwise, everything else remains the same. It has the same plastic component, the same motor blower, and all of that. So it was clearly an adjacency to coolers, and it sort of was a natural extension of what we are currently doing. But other than that, we are not, and at least at the moment, we have no plans of getting into any other product category within India. right? Whereas as I said, in Australia, we are into coolers and heaters, the built type, the installed type, but we are introducing the portable coolers, portable heaters, air conditioners, and in the US also we have introduced air conditioners, which we are buying from a company in China and giving to our customer over there. And we will continue to offer more products which are in the air space. In Mexico, again, these are all clearly opportunistic sort of moves. In Mexico, again, bulk of the business comes from coolers. We introduced heaters, portable heaters, a few years ago. That business has been, growing at a good pace. But in the next few months, we are also going to be introducing washing machines in Mexico. Again, for various reasons, it makes sense to do that because, because there are tariff issues and most of the other players are importing. So we'll be sort of, manufacturing that variety of washing machines locally, the only players so far. So there are these opportunities which we will keep on sort of seeking. But otherwise, at least as far as India is concerned, we are not looking at anything other than coolers and fans as of today.
Yes. Thanks, sir. That was very clear. Thanks for the for highlighting those. Thank you, sir. Yes.
Thank you. Our next question is from the line of Renu Beth from IIFL Securities. Please go ahead.
Yeah, I just two quick questions. One in Inco Mexico, how large is the non-air cooler portfolio for us today? And in your view, given the new category expansion that you're doing in the market, more of traded goods, how large could it become over the next 2 years?
So the bulk of the business is still air coolers, even in the US. Even in Mexico. The heaters is a relatively low value product. So although we have got reasonable numbers, in terms of value, it is nothing significant. The washing machine category is the only sort of relatively sort of higher value category that we are diversifying into in Mexico. How much what kind of traction it gets, how much it generates remains to be seen. So at least, for now, you may consider that the bulk of the revenue will come from air coolers.
So as of now, around 90%, even in Inco Mexico, is from air cooler.
Got it. Secondly, because this portfolio typically was relatively a soft goods portfolio and had seen a very swift recovery in 22. So can we expect, because of the diversification in the other durable categories, Inco Mexico should be able to grow between 15 to 20% CAGR?
That is something which we are, again, internally, that is something which we are, that is the kind of the plan that we have. But, we really don't make sort of forward-looking statements of that kind, so I'll refrain from, giving a number.
Sure. And just a soft check, you had mentioned in your comments that, Home Depot and some of the large clients in US are going for destocking and they've reduced the order pull-through versus last year. So just to get a sense, so this typically, when you say pull-through, the order values have been declined, so would it be like a marginal 10-20% kind of decline, or they're going for, because last year also the season was a bit mixed for them, or this kind of decline is like 40-50% kind of drop? I'm just trying to see the magnitude of withdrawal or the shrinkage in business that we're seeing in the current year from US market.
No, so the decline is of a very high magnitude of the kind of order which you mentioned.
Okay, got it. Okay, thank you so much, sir. All the best.
Thank you. Bye.
Bye.
Thank you. Our next question is from the line of Zishan Akhtar from Happy Games. Please go ahead.
Hi, sir. Sir, am I audible, sir?
You are.
Okay, so I wanted to know about the standalone entity. In India, what have been our sales distribution as far as India's geography is concerned, like north, south divide or east, west? Do you have any numbers on that?
Yeah, broadly equal.
Equal. Okay. So is there any part in India that you are focusing on to increase your sales, or do we get some more profits from a certain region in India? Is it that way?
Not actually, Rishad. So see, the profitability is linked more to the model mix. Different models have different profitabilities. So profitability is linked more to the model mix than the regions per se.
Okay. Now my second question is on, have we added any channel partners or dealers this quarter?
Again,
what is the status over there?
It's a continuous process. We do that every year. We've been doing that every year and we continue to do that every year.
Okay, sir. Okay. And one more thing, sir. We have decided to do the buyback at rupees 2,000 per share. Now, just a view. I just want to know a view from you. How have you decided this rupees 2,000 per share? Why not like 20%, 30% higher than the share price? Is there any specific reason for this?
We tossed the coin.
We dropped the coin. Okay.
So essentially, the board of directors and the management believes in the strong growth potential, possibility, and opportunities down the line. So essentially, that was the case, and that's how this price was decided.
Okay, sir. That's great. You are justifying that you are sticking to your asset-light model by giving back this money to the shareholders.
Yeah, basically, we think that this price is still at a discount to what we believe would be a fair value going forward.
Okay, sir. Okay. That's all from my side. Thank you.
Thank you. Thank you for asking that question.
All right, sir.
All right. Good night, everybody.
Thank you, sir. Would you like to add a few closing comments? That was the last question for today.
No, thank you. Thanks to all participants for sparing your valuable time, and thanks to Yes Securities for hosting this conference call. Thank you.
Thank you, members of the management. On behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.